Richard, what sort of names are you interested in at the moment? What really floats your boat when it comes to emerging markets?
Lots of things float my boat. Let's focus on probably the world's biggest, most important company, which is not Amazon, which is Alibaba. 600 million people in China buy stuff online through Alibaba. Interesting factoid for you. You can see that Alibaba delivers 100 million packages per day in China. Amazon operates in 13 countries and delivers 10 million packages a day. So in terms of scale, whilst everybody thinks Amazon is the world's biggest online retailer, the reality is Alibaba is the world's biggest online retailer. So the scale here is of a whole different level. And that's, of course, because the scale of the Chinese economy, whilst it is still smaller in aggregate terms than the US economy, the scale of the economy is at a different level to pretty much everywhere else. And that enables companies like Alibaba to really do extremely well. So when we think about the future of China, we see it shifting from the old-fashioned fixed asset investment export model to this kind of very much domestic, consumer-orientated millennials. There are 500 million millennials in China, and they only use mobile phones, and they spend their entire lives interacting through mobile phones, and Alibaba, in our view, is the best way to play that. The other thing which I wanted to emphasize to you today is a company that I would guess very few of you have ever heard of, and they make the wristbands that you use if you go, any of you who take your kids to Disney World. Globant is the company that makes these wristbands. And Globant is an Argentine company. So we talked a lot about the scale and importance of China. Argentina doesn't generally come to the top of the charts in terms of, either its market or technology. But Globant is an Argentine technology company which we invested in the trust back in 2015. It was a pretty small company at the time, $600 million market cap company. That company, since we invested in it, is up nearly 300%. It's given you a return 9 times more than you'd have got from the index and has been one of our most successful investments. So again, although China is the big, behemoth of the world, we do look around the whole of the rest of the emerging market world and find kind of interesting little companies like Globant Technologies. So very exciting opportunity there.
So emerging markets very much at the forefront of changing trends in the world. Now, I've seen a couple of you gasp as if you want a drink, and I know that it's just us and the Q&A session before you get a drink. So this won't go on much longer, but I think it's important to let the portfolio managers give their last-ditch effort to give some verbal blows to you, to give you some last chance of them to actually convince you that their funds are the ones worth investing in. But I would like to thank Peter before we got up here, because he made 2 statements, which I totally agree with. He said he doesn't mind paying fund managers, and he also would invest in funds rather than individual companies, and that's exactly what these funds do. So thank you for that, Peter. I totally agree with everything you say there. So let's start with you, Richard.
Right. Okay.
Why should investors invest in the Jpmorgan Emerging Markets Investment Trust?
Very simple. We take a long-term view. Most of you, I know, are on the same page and that kind of thing. Patience is extremely important. We have our ups and downs. We have some stocks that go wrong, but at the end of the day, we take a long-term view on the asset class. We've got, I think, the best research capability in the market, which backs that up. And most importantly, and I've touched on this a couple of times, the consumer of tomorrow is very much based in emerging markets. We've got 500 million millennials in China. We have 400 million millennials in India. That's 900 million people. That's more than the population of the US and Europe put together. So the future belongs to the emerging markets.
Okay, Tom. Thank you, Richard. Tom, you weren't very popular at the beginning. Can you convert your last chance to convert the audience to the European equity market, and more precisely the Jpmorgan European Investment Trust income shares?
Okay, so we've spoken a lot about Europe conceptually, from a macro perspective, from a corporate perspective. Just to begin with, what are we actually doing in this trust? We are looking to expose our investors, you guys, to the very best high-yielding opportunities across the European market. But we're taking our time to ensure that those companies that you have end exposure to are fundamentally good businesses, and we're making sure that we understand, appreciate, and like the footprint that those companies have, whether that's an oil major like Total or an Italian small cap like DeLonghi. We utilize a team of 40 investors to allow us to do that work and to look at a broad array of opportunities across Europe. Now, I think the three things to take away, if there are three key messages from me today, are, number one, we believe that Europe is okay. Whether that's from a macro perspective or from a corporate perspective, with valuations where they currently are, a 3.7% dividend yield in the Europe ex-UK market, a 25% premium versus its long-run average, and a further 20% premium to 4.5% yield on the trust itself, we think that's a pretty exciting opportunity. The second point I would make revolves around some of the benefits of using an investment trust to access the market. If you believe that risks have been mispriced, as we do, the investment trust vehicle is a fantastic way of exploiting that mispricing. And what I mean by that is that investment trusts can often trade at a discount to the net asset value of the underlying companies that are held within the trust. At this point in time, our trust is trading at a 12% discount, meaning not only do you get the attractive market valuation, you get a further discount on top of that. And again, I'm just going to reference a point that Peter made around leverage or gearing. By being within an investment trust structure, we can utilize gearing to supercharge some of the returns that we can generate. So not only can we generate underlying outperformance within the companies that we hold, but we can borrow additional assets to invest into those high conviction ideas that we have to generate excess returns. And over the last 10 years, we've added about 0.6% per annum to the excess return that we've generated over and above the market through gearing. The third point, and we lead it nicely onto that, is performance. This is a fund that's been running for a number of years now, and we have a proven track record not only of delivering returns in excess of the broad market, so about 3.5% per annum on average over the last 10 years, but we also have a great track record of delivering end investors an attractive dividend yield. So I've already spoken about the 4.5% yield. Another benefit that we have inside an investment trust structure is that we can use revenue reserves to help to protect against any dividend volatility on a forward-looking basis, and that has allowed us to ensure that over the last 10 years, and indeed since the fund launched in 2006, we have never cut the dividend that we have paid. So Europe looks okay. We think there's an attractive valuation opportunity today, and we've delivered pretty good returns over the long run in this product.
Thank you, Tom. So, has Tom done enough to convert any of you? And is Richard going to stay top of the pop? So, we asked the same question we did at the beginning. Which option below describes how you feel now, after hearing from both of our portfolio managers, about European equities and emerging markets? So A, if you're positive on both. B, if you're positive on Europe, negative on emerging markets. C, negative on Europe, positive emerging markets. Or D, negative on both. Please decide the portfolio manager's compensation now. Tom sat forward there, so he is very concerned. So what have we got? Oh, well, I think you've done a decent job there, Tom. You've managed to convert. So before it was 23% positive on Europe and emerging markets, 10% negative emerging markets positive on Europe, 57% was positive on emerging markets, negative on Europe, and 10% negative on both. So we've also managed to convert some dissenters who really were not happy about life at the current time and believe the whole world was in a whole lot of trouble. I'm not going to declare a winner because I think both our portfolio managers have done a great job. And can I please take this opportunity to thank you all in the audience for coming today. And if I could also ask you to please to show your appreciation for our two speakers for this session, Tom Buckingham and Richard Titherington.